Welcome again. In this case, I have the honor of having on the show Tobias Carlisle. Tobias is a friend. Toby is a friend. So for me, it's really exciting. And in this case, I'm accompanied by my co-host, Michael Morosi. And I'm going to just give you a little introduction about Toby. Tobias Carlisle is the author of The Aquarius Multiple, Concentrated Investing, Deep Value, and Quantitative Value. He's also the CEO and manager at Aquarius Funds, manages capital according to deep value principles discussed in research featured in his own books through two ETFs, ZIG and DEEP. By the way, the DEEP ETF, we're going to talk a little bit about it because it's a new thing and I want to learn a little bit about. So, Toby, thanks. It's a pleasure to have you on.
Thanks, Ivan, for that very kind introduction. Good to see you again. Good to see you, Michael.
Yeah, very nice to see you, Toby.
Yeah, absolutely. Okay, so first thing, Toby, can you talk us through this new adventure in which you are on board called DEEP and the relation with Roundhill? Because that's it's a little bit weird, so I want to know a little bit about it.
So I've recently started managing an ETF, which is a small and micro ETF, small and micro deep value focused in United States listed equities. The fund was previously a different ticker, and it was managed by a group who no longer wanted to manage an ETF. And so we took the ETF over in June last year and then managed it according to the mandate that it had at the time, which was a large cap mandate. But the objective was to transfer it over to a small and micro fund. So I have ZIG, which is a large cap, largest 25% of companies by number, and then DEEP, which is small and micro, which is the smallest 75% by number. And so DEEP follows the same philosophy as ZIG does. The difference is that ZIG is long short in the largest 25%, and DEEP is long only, and it's a little bit more diversified just because smaller companies tend to be a little bit, they have a little bit more risk attached to them. They can be a little bit more volatile. They're just not as well established. They don't have as much in the way of resources, and the business model in some instances hasn't been completely proved up. And so there's some risk as they make that leap from small and micro to mid cap or larger. And so we just diversify that risk away. But essentially, it's exactly the same model. It's just applied to a smaller universe. And the reason for doing it was, values had a very rough run for the last decade, but small and micro has also had a very rough run, to the point that maybe 6 months or 12 months ago, the size factor was sort of declared to be no longer offering any kind of outperformance at all. It just shows how tough this business is, that literally sort of after those pronouncements were made, size has had this spectacular run back, starting basically from almost the day that we switched over to a small and micro fund. It's run really strongly through to now. And I hope and I think that will continue on, because it's underperformed by so much for so long that it's got a lot of catching up to do. And it moves in very long cycles. So it was 10 years of underperformance essentially. And so I expect years of outperformance, and the valuation differential between those portfolios, between sort of the large cap market and small and micro, is huge. They're on any metric that you want to look at, they're very cheap, they're growing faster, and they're better capitalized in many instances, which was a surprise to me. So that's the reason I wanted a small and micro, wanted to get that exposure, because I thought it was one of the clearest opportunities around, and we got very lucky. We got the timing right.
One of the things that's always kind of struck me as interesting, first off, taking the other side of those pronouncements that anything is dead. Yeah, I think over the long run probably tends to work, Right. But at the same time, we're in this market where, private equity, for example, is just going from strength to strength, and these private equity managers are just tripping over themselves to deploy all of the capital that they've just been handed, but there seems to be a disconnect between saying, small and micro cap is dead, and I'm a pension fund and I'm going to allocate another 5% of my assets to private equity, because it's effectively the same strategy. I think if you disaggregate private equity returns, so much of the excess return is attributable to effectively the market cap focus. I mean, private equity is at its core kind of a small and micro cap market.
Yeah, the factors that drive private equity seem to be small, cheap, which is a value metric, and levered, which is they just, they gear up these companies when they buy them, so they don't have to put up as much equity, and then just paying down the debt delivers pretty good returns, introduces some risk into them. But you can, I basically, that's my strategy, small and cheap, without the leverage, because I think that you get better returns by having a higher quality balance sheet, a better business. But you're exactly right. That's the driver. The really surprising thing for me has been that private equity has been so well capitalized, and they haven't really deployed it into small and micro the way that they have in the past. And I don't really know the answer why. It's possible that, the introduction of Sarbanes-Oxley, which is some legislation that made it more onerous to be listed in the States, that happened after the 2000 crash, has made it more difficult to become listed. So companies tend to do what, say Facebook, where previously that might have gone public as a small or micro company, they wait until they're mid cap or large cap to list. And so those companies that had previously grown through small and micro now list at a much larger size. That's perhaps one driver of it. I haven't really found a good answer. I'm sort of speculating as to what the reasons might be.
Mm-hmm.
Yeah, actually, recently I read an article. It was written by Jack Forehand, that I know that is a friend of yours also, and he mentioned this thing about the return of the value factor, academically speaking, is it can be explained by the size factor and the negative quality factor. So you think this can be, can long over the next, because this situation is really the value coming back, or is this, and this is gonna keep in this way, it's gonna long this way, how do you say last? Sorry, it's gonna last.
Yeah, so the value factor is literally price to book. And what happened late last year and early this year is that companies that had been part of that, a lot of value got crushed through the COVID sort of March 2020 drawdown. And then the kind of companies that were in that value basket at the time tended to be companies that were quite asset intensive and low earning on those assets. So that was energy, financials, and other little bit kind of more unusual things like the cruise liners and did I say airlines? Possibly airlines as well. So when the reflation trade sort of kicked off in earnest in about September last year, all of those things absolutely rocketed, and the defining quality of them was that they had been quite financially stressed through that period. So when they ran, the price to book factor, the value factor worked very well. But then it was also this unusual thing where they were very low quality. So the quality factor as it stands by itself is a combination of factors, is a combination of characteristics like a strong balance sheet, so more cash than debt on the balance sheet, a business that generates cash rather than loses cash, bigger margins, all of the things that you might think are better defined in a business. And so the run last year was a price to book sort of asset intensive run and a low quality asset intensive run. And that lasted for about 6 months, really through until about early March this year. And since then, it seems to have been that those have cooled down a little bit, and the better quality balance sheets have started working again. So I don't really like price to book value as as a metric, just because the assets of businesses earn so differently. It's almost irrelevant what has been put into the business. It's the structure of the business itself that determines how they earn. So I prefer flow metrics like price to cash flow, price to earnings, or EBITDA to EV, or my metric, the acquirer's multiple, which is just operating earnings on EV, for the reason that it gives you a better expression of what the business itself does rather than sort of what the assets that have been put in. But that focus of mine did hurt me a little bit through when that sort of reflation trade happened. But I think, to Jack's point, that it was one of those things. It's likely to be, well, it seems to have been pretty short-lived, and now we'll go back into a more normal sort of quality type market.
Mm-hmm.
Yep. Actually, I think in this moment, talking about your metrics, why don't you can elaborate a little bit on the acquirer's multiple? I mean, many of us have read your books, so we know what you are talking about. But it would be interesting to, that you elaborate a little bit on that, because we are going to adapt this interview into Spanish, so a lot of people is going to know about it in Latin America and here in Spain. So it would be nice that you elaborate a little bit on that.
So the approach that I've done a lot of research. I partnered with a gentleman who was doing his PhD at Booth, and the product of that partnership was a book called Quantitative Value. And we basically went and tested every bit of industry and academic research that we could find on fundamental investment metrics. So that would include things like value, and it includes quality. We looked at credit. We looked at the earnings manipulation and statistical indications of earnings manipulation, statistical indications of fraud, and statistical indications of financial distress, which is the credit type approach. Out of that project, we found, because we looked at metrics that had been discovered in the 1920s, and they had been purpose-built for manufacturing companies, and they had weird coefficients before each of the numbers, which is clearly, that's what happens when you do some sort of back test and you try, you do a linear regression across some factors, you're going to get weird coefficients. And that may just be peculiar to that data set. It might be not something that applies going forward. So we wanted to see what had continued to work. And what we found was that many metrics had stopped working. If they ever worked, they were just sort of a product of they might have been data mined in those early days. Many things work on a cyclical basis. Sometimes they're in favor, sometimes they're out of favor. Shortly after they're discovered, they tend, so the one function is the accruals function, which looks at how much does a company earn versus how much cash flow does it generate. And when there's a wide divergence between what it earns on an accounting basis and what it earns on a cash flow basis, that has to, double entry bookkeeping means that has to generate an offsetting asset somewhere, and that's an accrual. And so what the researchers had found was that when companies have these accruals, often that indicates they're not earning much in the way of cash, even though they're putting up accounting earnings. And that can be perfectly normal for some businesses to do that. It can also be sort of an indication of perhaps some sort of fraud going on or some sort of earnings manipulation going on. So when that was discovered, it worked really well, and then everybody started using it and it stopped working. So that's what happens. But here's the funny thing. It's come back into vogue and it started working again because it's a good metric. It's just that when the managers themselves become aware that that's something that people start looking at, they find another way to sort of manipulate the earnings. And so the ones that are left are just the ones that are doing it because that's the nature of their business. The cash flows may not perfectly match up with the accounting earnings. So the one thing that we found that was quite enduring were the value metrics. So value metrics are very robust over long periods of time. If you find something that's undervalued, you can buy it and hold it and get excess returns, which is a better return than the market over a period. This is on average across a portfolio through time, over about 5 years, something being undervalued. And really, there's not much else that is as predictive as that. Some of the quality metrics are quite good. As we've recently discovered, though, and we're sort of new, but it's definitely been felt more keenly recently that value itself is quite cyclical. And so value, famously underperformed in the late 1990s, then had a very good run in the 2000s, then underperformed again, sort of for the last decade. So my metric is we tested all of these different value metrics, just very simple ratios. We looked at price to book, price to earnings, enterprise value to free cash flow, enterprise value to operating cash flow, enterprise value to EBITDA and to EBIT. So what we found is that EV, enterprise value to EBITDA, enterprise value to EBIT are the two best metrics. Enterprise value to free cash flow is another good metric. My small change to that was to say, let's reconstruct the operating earnings from the top of the balance, at the top of the income statement, rather than EBITDA, which adds, or EBIT, which adds back from the bottom line. And the reason to do that is it just makes it easier to compare two companies that have different businesses on a like-for-like basis. So the acquirer's multiple is it's the metric that private equity firms and activists use as the first step in determining whether this is something that is worth sort of looking at and potentially taking private, because we can manipulate the balance sheet, we can add debt, and we can use these operating earnings to pay down that debt. And because some businesses have a lot taken out between the operating earnings line and the bottom line, you can find something that looks like it's that's losing money or looks like it's under earning, but it might be doing quite well at an operating income stage. And that's something that it might not be getting the recognition that it requires. On the other side, it might also have, might have some hidden assets in the way of cash or other things on the balance sheet. And you might be able to acquire that a little bit more cheaply. So that's those two things together, just sort of underappreciated earnings on one side and perhaps underappreciated assets on the other. When they're found in combination, it tends to be something that outperforms. And when we test it, we find that the acquirer's multiple is sort of the best single metric. I don't use that in isolation. I use other things, but that's the driver of the philosophy. We're looking for things that are cheap on an acquirer's multiple basis.
Yeah, no, that's great. Yeah, and I mean, it makes perfect sense because it's almost, private equity and even in the public markets, it is a little bit kind of bring your own capital structure, and so, right. Basically the operating earnings are effectively the source, and you can do with it what you will. You can be aggressive, you can be underlevered, whatever, but at the end of the day, those operating earnings are kind of the fuel for the business and the fuel for returns. That's I think that's a great framework. It strikes me, and I just kind of wanted to know kind of how you incorporate macro factors into these kind of analyses of value cycles, for example. Because which you mentioned very correctly, value underperformed late 90s, outperformed mid 2000s, underperformed kind of post financial crisis. And you can basically overlay, you could call it nominal 10-year treasury yields, you could overlay inflation expectations, whatever, but some kind of measure of underlying growth and underlying kind of slack in the economy effectively, and it overlays pretty closely to those to those cycles. And so does that matter? Do you care? Is that kind of exogenous to your analysis, and they might point in the same direction, but it's kind of coincidental? How do you think about kind of macro regimes and valuation regimes?
I think the thing that most value investors will say about themselves is that they are bottom-up value investors and they don't care what the macro picture looks like. And the reason I think that they say that is because the macro stuff is so hard to get right. It's not that it's understandable as it comes through. It's not that it's not understandable. It's just that it's hard to predict what will happen from that point. Often because the people who are setting the macro, they're humans setting the macro factors on the other side. Interest rates are set by central banks. Then you've got whatever the government of the day is doing in terms of its fiscal policy. And so all of those tax regimes, all of these things, it's just too hard to sort of figure it out. And so value investors would say, well, we only focus on the bottom up. And to the extent that we focus on macro, it's macro in the context of the business. So, if it's an oil producer, we need to know the value of oil or where
supply
we think oil will be.
Whatever. Yeah.
Right. Exactly right. Having said that, value underperformed for so long that every single value investor became a macro guy trying to figure out why it was that it was underperforming so badly. And so they would have all gone through Is it the 10-year being too low? And it certainly seems that as the 10-year has picked up, value investing has come back to values come back to life. Is it inflation expectations? Because they were similarly crushed and they've reared their head again recently. And it seems like values come back to life coincident with that. And you could also look at sort of longer term cyclically adjusted value measures like the Schiller PE, which is the cyclically adjusted price earnings. Just look at an average of inflation adjusted earnings over the last 10 years, compare that to the current price level. Tobin's Q, which compares the replacement value of assets with their market value. Or you look at something like Warren Buffett's favorite indicator, which is gross national product relative to the size of the stock market. On any of those measures, the US is extremely expensive at the moment. And historically, when country has got extremely expensive versus other countries, it's tended to underperform. The best example of that is Japan in the late 1980s to early 1990s. It was a huge portion of the global stock market, even though it was it's still a very big economy, but it was sort of half the size of its stock market. Relative to other stock markets. So it was sort of 2 times overvalued, and it got to a Schiller PE of 100, and as a consequence, it's still not over where it traded in 1990. It's been a very long, drawn out recession, depression, stock market bust for the Japanese. So I'm conscious of that possibility always when I'm running the funds. Having said that, it doesn't really factor into what we do because, as any researcher will tell you, it's extremely difficult to time factors. We really don't know why one factor starts working or another factor doesn't work anymore. And so value, I don't think of myself as a factor investor, as a value factor investor. I think of myself as sort of an idiosyncratic bottom-up value investor. Having said that, though, I have to recognize that influence is real. I mean, that definitely does happen, that value goes through these very long cycles. So I don't think about it when I'm constructing the portfolios. However, I'm sort of aware of its influence on the performance of the portfolios, even though I think that value itself is this sort of evergreen strategy. How can it not make sense to buy something for less than it's worth and let time pass and have the market recognize that? It definitely does work. It's just that there are different swirling sort of factors in the market, and the last 10 years have been characterized by very large companies that have been growing very fast, and they've tended to be tech type companies that have been in that group. And just if you think about what value is not going to be buying very large companies. It's not going to be typically not buying very fast growing companies, because they tend to be recognized by the market and they tend to be expensive as a result. So sort of that was a very long-winded answer to say that, yes, I'm aware that it influences me, but I really don't know how to use it, so I don't.
Yeah. And like I said, I mean, the conclusions very well, might be exactly the same, and it's just, and it tends to be, in my experience, if there's cohesion between, some kind of top-down view and some kind of bottom-up view, and they're kind of pointing in the same direction, well, that's probably the direction things are going, and obviously, like you said, I mean, timing regime changes or whatever is exceedingly difficult. But I would say, from what I'm seeing, kind of your view that that this cycle might have a way to run. I think that there could be some of that cohesion.
I think that, I mean, it's hard because I hope one thing and I think the same thing. And so I don't know if it's what I hope overwhelming what I think, but I do think, we can look at the 10-year. The 10-year has been crushed for a decade or for longer, for 30 years, from, it was like 16% in the 80s. And now last year it was like 0.5%.
Yep.
And now we're sort of 1.6%, and it's backed off a little bit from sort of 1.7, mid 1.7s. And so I can look at my fund's performance, and that it seems to have tracked that as the 10-year turned, value seemed to turn at about the same time. And as value, the 10-year was really rocketing up for a few months there, and value was, rocketing up alongside the 10-year. And then you've got inflation expectations there. So expectations are sort of what the market thinks. It's not really a measure of what's happening, although, is inflation coming? I mean, I can't really see how it's not, because we've dumped a whole lot of money into the global economy, and we've certainly retrenched the amount of stuff that we're making. We've had this big supply chain issue through the quarantines and through the Suez Canal, and all of these sort of things have been going on. And so it seems that there are shortages for certain things here that I would like to get, just at home. And so there's certainly that when you combine the flood of money into the market by central banks, plus the sort of the supply restrictions or constrictions, that seems to me that there's going to be inflation, and inflation is good for value investors, whether that's transitory or whether that's going to be enduring. I mean, I have no idea. When I hear these guys arguing about this stuff, I glaze over a little bit, because I don't think that they know either. But
no, I to be honest, I think that's a great point. Right. I think, the Federal Reserve, puts on their pants one leg at a time, just like everybody else, and they might have marginally better data, marginally quicker data. But to be honest, I don't think they're really seeing anything different than, no. Bridgewater or Goldman or whoever, you know what I mean? So.
They certainly seem to think that they're seeing something different, because I would say that if you ask the average man, or if you ask, the person who buys the groceries, do they think prices are going up? They'd say yes. Mm-hmm. Is it reflected in the CPI to the same extent? The answer is probably no. So the Federal Reserve, they have some incentive to keep inflate, to say that inflation is a little bit lower than it may actually be. And, I don't know what impact that will have. Maybe they're behind the curve the whole way through, and inflation sort of gets away from them. I think that's a possibility. This is getting very macro. It's kind of beyond what it's above my pay grade to comment on it, but I'm having a go.
Well, I have another question, Toby. Coming back to your pay grade, that is, you have been talking about, this is the last question of this first part interview, okay? And you have been talking about your secret sauce, let's say, the Aquarius multiple, but you don't use just that. You said that wasn't used in isolation. So what else could we call ingredients of your overall recipe to wrap up a little bit the interview?
Well, let's just talk a little bit about I think the spectrum of value investors. On one side of the spectrum, there are guys who are looking for very high growth, high quality businesses that can compound. And the way that they are finding value is by saying, this thing will be 3 to 5 times bigger in 3 to 5 years. And so we can buy at a price now that it's optically expensive. It looks stretched, but in the context of where this thing will be, we're getting a good price now. I think that is quite difficult to do. And I think that historically that's been, you've earned subnormal returns doing that, simply because it's so hard to do. We tend to be too optimistic when we make those prognostications. So I'm at the other end of the spectrum, where I say, let's assume that we're not going to get any growth at all. Let's look at this thing in a steady state, or, maybe inflation is the only kind of growth that we're going to get. And now, can we buy it and still get a good return on that? And that has historically been quite a good way of doing it, for the reason that often many of these companies surprise to the upside when the expectations are so low for them. And so that for whatever reason, they might be in the middle of a trough of their business cycle or something like that. And we just, as humans, we tend to extrapolate that trough out too far, or we extrapolate that earnings, falling too far into the future, when what tends to happen is mean reversion. So given that that's the way that I invest, the things that are important to me are survival first of the company. So I want to make sure that the balance sheet, are they appropriately geared? Do they have the right amount of cash or debt, whatever their funding mix is for the business that they're in, so they can survive these the vicissitudes of the business cycle, the swings up and down of the business cycle. And once I'm comfortable that they do have that, sort of balance sheet strength. Then we also have to look at the business. Is this a good business? Is this a business that we want to own? Because some businesses just don't ever earn their cost of capital, and they appropriately trade at a discount to their assets. So what I'm trying to find is a business that is a little bit better than the market thinks that it is, can sustain what it's doing at the very least with the possibility that it can grow. And so I look for, on that basis, I'm looking at margins. Do they have strong margins? Are they able to pay their suppliers less than they earn from their customers and sort of sustain that margin? So you either want a very big margin, or you want a very stable margin, or a growing margin. And so those are the sort of businesses that I like to look for. It's funny, the kind of things that come into that screen. You'd think that I'm describing some sort of it might be a consumer staple or something like that. But sometimes, so I think that the gold miners have got religion over the last sort of decade, because it's been a tough time to be a gold miner. So they now do all tend to have quite good balance sheets, and the businesses seem to be a little bit better. It's a commodity input, so the margin's always going to be more difficult, but they can control their costs. They've got lower inputs, pretty stable, pretty good gold prices at the moment. So that's just one example of the sort of business that we could buy, because it's a cyclical type business that the franchise growthy investors would stay away from. But it's the kind of thing that I would buy under the right circumstances. And so that's sort of the approach. We do buy cyclicals. We try to buy them at the bottom of their cycle rather than at the top. We try to buy them when they've got good balance sheets and can survive, because we don't know what's coming either. So that's the philosophy is good balance sheets, good businesses, or underappreciated businesses, and a long enough sort of runway to let the thesis play out.
Where our audience can find you, Toby? Twitter handle or LinkedIn, whatever, if their website.
Yeah. So the firm that I run is acquirersfunds.com, and the fund is acquirersfund.com, or you can search Deep ETF, and that'll take you to the Roundhill site where that is hosted. And then I'm on Twitter at Greenbacked. It's a funny spelling, GREENBACKD, or Acquirers Multiple, which is my little website where I just got a screener and we just put up interesting research that we find, or podcast conversations that we have with people. It's more for fun than for anything else.
So thanks a lot, man. It's been really, really interesting, this interview. And now we will keep with we're going to keep talking in the second part. Okay. But thanks a lot. I don't know, we'll see. I think we will do more follow-ups of this interview when the time comes. And
yeah, I'd love to.
Nothing else. I just appreciate it a lot.
Thanks, Ivan. Thanks, Michael.
Enjoy it, Toby. Take care.
So thanks to our audience also. And remember, give us a like and subscribe to our channel if you like it. And nothing else. See you in the next interview. Bye-bye.